Hi, welcome to the Investment Blueprint. I'm your host, Raghu Kumar from Rain Technologies. The Investment Blueprint is a weekly podcast where you can find me interviewing real world quantitative traders and investors, hedge fund managers, and industry experts in the field of quantitative, data driven trading and investing. My goal is simple. I want to help you make more consistent, profitable trading decisions in a data driven and meaningful manner. Today's topic is on how to do algorithmic trading in India, with a focus on how to come up with your winning strategies for algorithmic trading. The goal of today's episode is to make it a little easier for you to basically come up with sound winning algorithmic trading strategies. If you caught our episode from last week, I interviewed Lakshmish Rao, one of Rain's chief investment officers. Well, today we interview the other CIO, Bharath Rao, who Lakshmish referenced a few times last week. Bharath and Lakshmish have known each other for quite some time. And while inevitably Lakshmish tends to do a little bit more of the day-to-day backtesting, Bharath is always keeping a strong bird's eye perspective on how things are going. Together, they ran a company called Alpha Matters, where they built and licensed proprietary trading strategies for India's capital markets, the US markets, and all sorts of asset classes in between, including cryptocurrencies and Forex. Today, we try to get Bharath to answer a few questions on how he generally tries to build a framework for winning strategies, what a winning strategy even means, and what an aspiring quant can do to replicate Bharath's success. So, Bharath, welcome to the podcast.
Thanks, Raghu. It's a pleasure being here.
Awesome, man. So, I thought we can kind of start with just your general background to trading, and specifically, algorithmic trading.
Well, to be honest, I had no background in trading at all, right? I came from a world where I did some bug fixing, I did marketing, ecosystem building, digital advertising, analytics, so on and so forth, but not trading, right? But I studied finance and derivatives, financial engineering, and so on during B school quite diligently. And I always track the markets at some frequency or the other. May not be daily, may not be hourly, but at some frequency, I always track the markets. And I miss making money when the Lehman crash happened on the downside or on the upside. Well, I made a little bit on the upside, but that kind of increased my focus on the markets, and I started tracking markets even more regularly. That's the background.
Nice, man. That's really nice. So basically, you have like a very kind of coming out of left field perspective to this whole thing.
Yep, yep.
Yeah. So, obviously today's topic is more about like how to build winning strategies, right? What's your definition of a winning algorithmic trading strategy?
Well, I'm not a big fan of cricket, but let me borrow a phraseology from cricket by this gentleman called Ravi Shastri. When he
Yeah.
was a commentator and as a coach, I don't know, he used to say that to win a test match you have to take many wickets. So let me try something as cliched but as true, right? To win trading, algorithmic or otherwise, you'll have to beat the transaction costs and the slippages. Otherwise, it's a losing game, right? You could do that by having a superior winning ratio. I mean, by when I say superior, superior to coin toss. Or you can win big when you do and lose less when you lose, right? So, or a combination of the two, right? So, according to me, the following metrics are reasonably important. I mean, there are hundreds of other metrics, but in my experience, these have been the most meaningful. You need to make a reasonable profit per trade just to make sure that your profit is not wiped out by transaction cost slippages. Number one. Number two, you need to have a decent sharp. Otherwise, you don't even know whether you're just getting lucky or making money by design. I mean, that's more to validate yourself. I would say two is like a decent sharp at a portfolio level. Number three, you shouldn't be dependent on very few very big wins to make your money. Right? That's called high kurtosis in statistical language. So that's avoid at best at the portfolio level. Again, if part of your portfolio has high credit losses, that's okay. And lastly, you need to be as close to beta neutral as possible, right? When I say beta neutral, what does it mean? When the market goes up, you should make money. When the market goes down, you should make money. When the market stays flat, you should make money, right?
Hmm.
Need not be every day, but could be every week, could be every month, could be every quarter at least, right? And if you're not making money quarter on quarter, then trading is not a great game to be in.
Right. Yeah, it makes sense. So basically, you've been in this field for quite some time, right? I mean, just generally this whole entrepreneurial space and being involved with companies at a startup level. Um, so prior to, joining us at Rain, you were involved with Alpha Matters, right? So how did you kind of come up with that decision to start Alpha Matters? And was it difficult to make that decision?
Well, that wasn't very difficult. There was this ex-boss of mine who was a machine learning expert, and he used to crack fantastic problems in image processing and bunch of things using machine learning, right? But not in markets. So, and since I had begun to track the markets very closely, at least on a day-to-day basis by that time, there was this bug in my head that we could use data science to crack some problems in the markets, right? And I had known who would be my future partner, Mr. Ganapati, for some time, and we happened to meet, and we found that there is enough overlap of ideas to do something in this space. The biggest challenge, of course, was both of us were business guys, so we had to learn coding from the first interns that we hired, right?
Hmm.
And the switch from marketing to markets was quite stochastic by itself.
What does that mean, stochastic? Sorry.
Yes. So marketing is a lot more deterministic, right? So
Hmm.
when you forecast demand, when quantify consumer behavior, all of that, that's not going to change overnight. But markets tomorrow can be very different from markets yesterday.
Hmm.
Yeah.
Got it. Yeah. Got it. So it's not so like linear, basically.
Not so linear.
Yeah.
It's not so slow changing. It's
Got it. So, we actually talk a lot more these days about marketing and things like that, which is, I think, very fascinating because it does kind of force us to think about things differently, right? Um, but, just generally more kind of focusing on the industry here and the future of trading, right? Where do you think the future of trading is going and why?
my gut says that trading and even the data says trading going forward would be less manual, more automatic. Manual will not die, but it will be more automated. There could also be changes in, because of that in market microstructures, brokerage structures, how the brokerage business runs, how the
Hmm.
exchange revenue model runs, and so on. Right. While this whole scheme of per order brokerage is very attractive from the outside, for an algo trader, it turns out it's not very attractive, right? So
Hmm.
going forward, brokers, exchanges, all of them might, align their incentives slightly better towards algorithmic traders. And that might be the way to survive and thrive for them, right? And
Yep.
hopefully regulators will also take a cue.
Yeah.
And hopefully everybody takes a cue from crypto, where transaction costs are simply a function of the capital you deploy, period, right? No other fixed cost.
Hmm.
Yep.
Interesting. Okay. No, so I've never really tried, actually actively traded crypto. But so basically, you're saying the structure of cryptos is fundamentally different than, say, general stocks.
Well, the structure of crypto may or may not be different, but the structure of crypto exchanges, the way their revenue
Right.
models are built, is
Hmm.
fundamentally very different, much, much more free market.
Got it. How is that exactly?
Because, I mean, your transaction cost, right, for example, is simply a function of the volume which you're trading. There is no lot sizes, there is no minimum commission, there is no per order, there is,
Got it.
you know,
Yeah, it makes
there's
sense.
there is no fixed cost, that you will incur regardless of everything else.
Right. Which makes it much more easier to scale strategies and things like that, right?
Everything, right?
Yeah.
I mean, it makes for a small ticket guy with $100 to experiment, right?
Hmm. Right. Makes sense. Yeah. So, in terms of other trends, what sorts of trends do you kind of see kind of playing out in just generally the wealth management space? So looking at investing and trading, and then kind of taking that, a step further. Where do you see the gaps kind of being and developing between the retail and institutional segments of society?
So in the wealth management space, right? I mean, what was wealth management as of today, right? Or for the decades up to today, it's mainly been mutual funds, some kind of mix of debt, equity, gold, real estate, right?
Hmm.
However, the point, I mean, the equity is the best performing of all these by far, right? However, there are problems it solves, there are problems it doesn't solve. Buy and hold, long only equity investing solves the problem of retirement, accumulating a decent corpus over the very long term, right? However, there are things that it doesn't address, short term goals. It can be really volatile in the short term, which is okay, but you really need to set that money aside and you need to do something else for your short term goals, right?
Right.
So, I would say absolute return, the idea of making money regardless of where the markets go, quarter on quarter on quarter, or at least attempting to do that, will increase a lot. And the appetite to do that among HNIs and retail is also likely to increase, as we see in grain itself, right? We see the
Yeah.
tendency increase in general, right? Because, if you look at the last 2 years, right, buy and hold investors pretty much made like 20, 20% kind of a return in this.
Hmm.
But a decent enough trader would have made money on the downside and on the upside, right?
Right.
And what if the market is flat? So the buy and hold guy does nothing, right?
Hmm.
The trader still has, a good trader still has hopes of making something, but not everybody is a good trader. So that's where, tech vendors
Hmm.
like tech come in,
Hmm.
where we make sure the money is risk managed, right? Our products make sure we don't, right?
Right.
The money is managed and, the clients don't blow out and we ensure a high quality of return, not just
Hmm.
high return, but not so volatile return.
And also the nature of the return itself, like where is it coming from, right?
Exactly.
Yeah.
And the nature of the return comes from the behavior of markets and, what we understand about the markets rather than beta, which is, just markets going up.
Right. Which is what everybody's chasing. Yeah. Yeah. Right. So let's kind of shift gears a little bit and focus more on algorithmic trading, right? Which is what we do at Rain. What's the general life cycle like of an algorithmic trading strategy from start to finish?
Well, strategies can be valid, valuable for anywhere from 2 years to 20 years, to even more perhaps, right?
Hmm.
That's just a function of, how fundamentally strong the strategy is, right? Or how the underlying behavior, how unchanging the underlying behavior is, right? But like everything else, it starts with a decent idea. So when a decent idea strikes me, either within my head or through somebody else or through some other phenomena I see in the outside world, I start by playing the devil's advocate, saying, why should it work to begin with? And if there is a half convincing answer, I will proceed and, try to formulate a back test around it, right? And if the back test fails, again, end of story. If it succeeds, then I make sure I have some data left to forward test it, just to make sure that I'm not overfitting. Guys who know machine learning will understand the concept of overfitting very well. And even guys in the markets know that, right? When we too tightly fit a model to the data, the more likely it is to fail in future. I mean, this is also in line with the Occam's razor kind of a principle, right?
Mm-hmm.
The more complicated your model is, the more likely it is to fail.
Mm-hmm.
So I keep some data to make sure that this doesn't happen. And again, if it fails the forward test, end of story, back to drawing board, right?
Yeah.
If it succeeds, then we either paper trade it or trade it in real life with a small amount of capital, right? And we fix timelines in terms of to decide no go, no go. Within the time frame, if it succeeds, then we productionize it and calibrate it, look for points of failure when it's likely to fail and watch out for it, and scale up slowly, right? And if it fails in this live testing period, then again back to drawing board. So
So when you do that, really specifically, when you say back to the drawing board, are you just like chucking it away? And do you consciously tell yourself, I'm not going to revisit the strategy because there might be some bias in doing that, or no?
right, depends on how strong the underlying principle is, right?
Mm-hmm.
If it's just data playing out, I'm more likely to throw it out than if it's human behavior that's driving it. Then I'm more likely to find a different way of capturing that.
So let me kind of go through an example here. Let's say you have a strategy, right? You've been thinking about it for some time. You split that data into the data you want to backtest on and the forward testing data and all that. You run the backtest based on certain parameters, right? And the results are not so great, right?
Right, right.
So do you because I mean, like I've been there, right? So do you and there's no black and white answers to these things. Everything is relative and subjective, right? But just generally, right, when you kind of face that, how often do you find yourself like tweaking the parameters versus saying, hey, I'm going to put this aside and check it out later on or something?
Well, I mean, if I have a decent amount of data that's set aside, that's untouched, left for forward testing, then it doesn't matter how much I tweak the parameters on the back test, right? But the same parameters have to succeed in the forward test, right? If that doesn't happen, then it's shut down.
Got it. So you never like go forward and then go back.
Well, that
Right.
that will ruin the sanctity of the forward testing data.
Exactly. The whole purpose of having forward testing in the first place, right? Yeah. But it's so easy to do that, right? I
Yeah, it's
mean,
very easy to do that. So,
yeah.
which is why it's also a good idea to have two sets of forward testing data, so that at least one of them remains unutilized. Period.
Hmm.
Right. So
Yeah, that's a very
even if
interesting.
you do this back and forth, you test it out on the finally unused part, and then if it fails, then you know that you're just overfitting,
Yeah. So
and
maybe
you're
a
better.
general good idea. Yeah. So maybe a general good idea, just for generally for anyone listening to this, is to have those rules written out, right? Like, what are you going to do when you start testing? You know. Yeah. So again, switching gears, right? Let's talk about crypto again. So because you guys do, talk a lot about crypto, you and Lakshmish, and so at the algorithmic level, how is it different to trade something like cryptocurrencies versus stocks?
Well, it's not difficult at all. In fact, if anything, it's easier. The only thing is you need to open an account with Binance or some exchange and move the money there, right? So that's the fundamental thing. So you can keep your money in Tether, which is called USDT, which is like fiat currency. I mean, which is like equivalent of the dollar. It's not going to fluctuate. Or you can keep the money in Bitcoin or Ethereum or any of these currencies. It's all up to you on how bullish you are in the long term as an investor, right?
Hmm.
You can use that money for trading, and you can use the APIs these exchanges provide for trading. The most important thing is to crack the alpha, and to crack the alpha, you need to understand the nature of the underlying, right? In my sense, any kind of a breakout trend following kind of a philosophy works reasonably all right in the crypto world, right? How well you capture it, and how well you filter the noise is all up to the sophistication of your algorithm, right? The idea is to, however, not be over levered, although these exchanges give you like crazy leverages, 100, 125, and so on,
Yeah,
right?
it's crazy. Yeah.
The idea is not to use that kind of a leverage because in my life, I've not seen strategies, that can take this kind of leverage and still not burn out.
Yeah, because what happens when you lever that much, you're also levering your drawdown, right?
Yep.
And then, yeah, yeah, makes sense. Got it. So, obviously you guys joined us recently, right? Still getting to know you and Lakshmish. What are the sorts of challenges you guys face as a CIO of Rain?
Well, there's two kinds of challenges that I would say. So one is the short-term challenges, given that algorithmic trading in India is relatively new, right? There could be hundreds of problems every other day from brokers, exchanges, some instrument coming, something not coming, data coming, data not coming, orders going through, orders not going through, right?
Yeah,
Market orders getting rejected, there could be a ton of these things that can happen, right? So these are the day-to-day challenges, and with time the ecosystem will improve and everybody will improve. However, in the long term, we've kind of set a high bar for ourselves, and what kind of returns to expect from us. And while we might tell clients that don't expect anything, the past is not an indication of the future. The
yeah.
clients will kind of take your past returns as a benchmark, right?
Hmm.
So the long-term challenge we all address every day, pretty much every month, is how to live up to that while constantly increasing the quality of the return, which is reducing the volatility of the return, right? And
Right.
that's the game we're in. And of course, in terms of strategies, evaluating strategies, what do you do with a strategy which has a low Sharpe but adds a decent level of diversity to your portfolio? And these are the operational decisions that have to be made. And how to retire a strategy when you suspect that it has outlived its utility. And this is not an easy thing to do. And you have to convince
Yeah.
your colleagues like everything else, right?
Yeah.
Uh, so, or convince them otherwise, or have them convince you one
Right.
way or the other, right?
Right. Right. And let the best decision play out. Right. Rationally. No, I mean, what I love about this whole space is that there's an art and a science to it. Right. You can
Yep,
read as many blueprints as you want. You can listen to as many podcasts as you want. But ultimately, you have to be able to make subjective decisions in a relatively high pressure environment, especially as you experience success, right?
yep,
As you experience success, everything just scales up more and more, and then the decisions matter more and more. So I think it's really interesting.
yep. And
Um,
user
yeah,
base and the money they deploy can scale very, very fast for any CIO.
right. Yeah, you can make a quantum leap just like that, right? So I think what's maybe important in those situations is to apply the same mindset. Actually, right? Is to not change your mindset. So, what are the important attributes of like a successful algorithmic trader?
I would say, a successful algorithmic trader is like a chess player or a poker player or
Yeah,
or a tech guy, who's completely emotionless about what his product, what his code does, or even just a trader, right? Who trades for a living, right? Who knows, when to take the losses at least intuitively, right? The idea is to be as little emotional as possible, have a statistical eye for things, right? Capture profits from black swans, or at least avoid making losses on them when you can. And know a bit of history and economic history in general. If you read The Wealth of Nations, it's not going to hurt you.
right,
If you read Keynes's general theory of employment and interest rates and stuff, that's never going to hurt you. Some of it may be useful, some of it may not be useful today, but you know, uh, economic history is important, in my opinion.
Got it. No, there is such. I mean, you kind of see this sometimes, right? People say you can get paralyzed by analysis, paralysis by analysis, and
Right.
having too much information just in your brain. But my counter argument to that is, I think it depends on your intent, right? Like if you're just looking to get smarter and just more knowledgeable about how the markets behave and perform, that's not going to hurt you, right? But if you're getting so caught up on like a million different types of trading strategies and getting really caught up in like the minutia of details, that maybe could backfire, right? Because you're preventing yourself from thinking about situations from a more holistic level, if that makes sense.
Yeah, I would think so. At,
Yeah,
but I mean, like all of us, we have to make day-to-day decisions, right?
right,
Because clients buy our product license with an expectation.
right,
I mean, we cannot afford to get too theoretical and do nothing.
right.
Have to do something, and when we have to do something, we have to prioritize, right? And my favorite author, Thomas Sowell, uh, says, it's about optimizing the use of resources that have alternative uses. In this case, that's our time.
Yeah,
We have
time
to
is a
do that.
resource. Yeah, yeah, 100%. You have to optimize time, usage of time. Yeah, makes sense. Um, Last kind of question, right? Just generally speaking, what are your kind of personal and professional goals when it comes to this whole space? I mean, rain is there, right? But just generally, what are you kind of looking to happen, from a high level and personal perspective in this whole, space that we're spending time in every day?
Right. So professionally, I would want Rain to be able to take in and run with and do a good job with 10 figures in about 3 to 5 years, right? Personally, I want to invent something in the finance economic space, uh, something original, some original idea. And in a deeper personal space, I want to understand the origins of religion and the place
Wow.
where
Okay. I wasn't expecting that. Yeah.
mythology and history merge or decided to fork.
Hmm. That's pretty deep. And what's amazing about an answer like that is I think all these things are related, right? In a weird way. Yeah.
It's all
Sounds
constructs,
really
right? I
cool.
mean, money is a construct, markets are a construct, religion is a construct.
Exactly. Exactly. Constructs of humans, right? We've been developing and evolving over time, and we've found ways to kind of appease ourselves in certain ways, right?
Yep.
Um, but ironically, that's what makes society function, right? So that's amazing. Yeah, really cool. Awesome, Bharat. Thank you so much, man. That was a great interview, and we'll talk soon.
Good talking to you.